if you read the financial headlines right now, the narrative is honestly pretty apocalyptic.
Oh, absolutely. It is all doom and gloom.
Right. I mean, regional banks are supposedly on life support. Like, the prevailing wisdom is that they are just being crushed.
Yeah, crushed by the Federal Reserve rate cuts, squeezing their margins, while they are also, supposedly holding the bag on this massive commercial real estate collapse.
Exactly. But today, we are looking at a $3.6 billion bank in Louisiana that is somehow widening its profit margin.
And walking right past the commercial real estate panic completely unscathed.
It's wild. Like, how does that actually happen? Okay, let's unpack this. Today, we are diving into the Q1 2026 earnings of Home Bancorp, ticker HBCP.
They offer just a truly perfect microcosm of what is actually happening on the ground away from the noise of Wall Street.
Right, because they operate 43 locations across southern Louisiana, western Mississippi, and Houston, Texas.
Which provides an incredible lens into how an institution balances these massive macro-level headwinds with hyper-local, highly specific strategic plays.
I mean, think of a regional bank like the circulatory system of a local economy, right?
That is a great way to look at it.
Yeah, if you want to know if the body is healthy, you don't just look at the surface. You check the blood flow.
Are local businesses drawing down capital to expand? Or is cash pooling up in reserve?
Exactly. Today, we are checking the vital signs of the Gulf Coast. And the data tells a story that completely defies those national expectations.
Well, to check those vital signs, we really have to start with the fundamental architecture of their balance sheet.
Right, so they are sitting on $3.6 billion in total assets.
Yeah, but the first quarter of 2026 saw a fascinating divergence in how they are actually managing that capital.
Because total loans contracted slightly.
Exactly. They dropped by about $16 million, bringing total loans down to $2.7 billion.
Which is roughly a 2% annualized decline. So the deployment of capital slowed down.
It did. But at the exact same time, deposits just flooded in.
They added $54 million this quarter.
Right, which brings total deposits up to an even $3 billion.
And the composition of that influx is what really caught my eye, you know?
Yeah, it wasn't just institutional money parking overnight.
Exactly. Their core non-maturity deposits surged 5.4% in just 3 months.
Which equates to a massive 22% annualized growth rate.
You are watching management actively pull levers to change their risk profile here,
They are definitely pumping the brakes on loan origination.
while aggressively accumulating deposits. And that pushed their loan-to-deposit ratio down to a highly insulated 90.1%.
And that 90.1% ratio, that is a deliberate strategic posture.
How so?
Well, if we connect this to the bigger picture for the listener, liquidity is the ultimate premium in the 2026 economic environment.
Oh, for sure.
Having $2.3 billion in core deposits means absolute stability.
Because these are operating accounts for local businesses.
Right.
Primary checking accounts for families.
Exactly. That money is incredibly sticky. People do not just uproot their primary banking infrastructure on a whim.
Right. I mean, if you've ever worried about bank runs in the news, this ratio is the exact metric you should be looking for to sleep soundly.
Because that built-in inertia protects the bank from the sudden liquidity crunches we've seen tear through the sector lately.
It's like a massive retailer intentionally moving more inventory into the back warehouse.
While deliberately slowing down sales on the showroom floor.
Yeah. A 90.1% loan-to-deposit ratio means they aren't relying on wholesale funding.
If the market seizes up tomorrow, they aren't the ones scrambling for expensive overnight borrowing just to keep the lights on.
They built themselves a fortress.
And it gives management the breathing room to be highly selective about the credit they do choose to extend.
Because you don't have to chase risky high-yield loans just to cover your funding costs.
Right. Not if your funding is secured by billions in stable, low-cost core deposits.
And that breathing room is incredibly obvious when you look at their physical footprint.
Oh, you mean the new branch?
Yeah. John Bordelon, the CEO, noted in the release that they just opened a brand new full-service location in Tomball, Texas.
In March of 2026.
Exactly. I mean, you don't sink capital into brick-and-mortar expansion if you were playing defense.
You don't sign long-term commercial leases and hire new staff if the sky is falling.
Right. It is a quiet flex of their underlying strength.
They are pacing their lending because the macro environment is murky, sure.
But they are playing aggressive offense on deposit gathering.
They are gathering dry powder, positioning themselves to dominate when the credit cycle inevitably turns.
Well, gathering dry powder is great in theory, But usually, if a bank slows down its lending,
And starts paying out interest on a massive influx of new deposits.
right, profit margins take a severe hit. You are taking in more liabilities without generating new assets.
But that didn't happen here,
Not at all. Their net income held rock solid at $11.4 million,
which comes out to 1.45 diluted earnings per share.
and the return on assets climbed to a very impressive 1.3%.
But the margin metric is the really crazy part.
Yeah, this genuinely made me do a double take. Their net interest margin expanded by 10 basis points,
Jumping from 4.06% up to 4.16%.
which is arguably the defining triumph of this quarter for their executive team.
Oh, absolutely.
But wait, I have to push back on the mechanics of this because the math feels entirely backward.
Based on the broader rate environment, you mean?
Right. The sources note that the Federal Reserve cut rates in mid-December 2025.
They did.
So this entire first quarter operated under that newly lowered rate regime.
And traditional asset liability management dictates that when the Fed cuts, bank margins get squeezed.
Exactly. The floating rate loans they hold immediately start yielding less interest income.
Right.
So how on earth does their margin widen by a full 10 basis points in a rate cut environment?
What's fascinating here is the sheer speed of their liability repricing.
Okay, break that down for us.
Well, the textbook theory you just outlined holds up perfectly on the asset side of Home Bancorp's ledger.
Meaning their loans did pay less.
Yeah, their average loan yield did decline. It dropped 3 basis points down to 6.41%.
So they absolutely felt the Fed cut on their incoming revenue streams.
They did. But they managed to slash the cost of their interest-bearing liabilities at a vastly accelerated pace.
Wow, how fast.
While loan yields dropped 3 basis points, the average cost of their deposits plummeted by a massive 22 basis points.
Falling all the way down to 2.29%.
Exactly.
They dropped their payout costs almost overnight. They repriced what they owe 7 times faster than what they are owed.
Which is just a masterclass in balance sheet engineering.
It is highly deliberate structuring, right? It requires anticipating the macroeconomic weather.
Building the roof before it rains. Just look at their certificate of deposit portfolio.
Okay, what are we looking at there?
They carry roughly $715 million in CDs.
Right.
And a staggering 96% of those are scheduled to mature within the next 12 months.
Wait, really? 96%?
Well,
That is incredible. So as almost $750 million in high-yield CDs from the old rate hikes rolled over in Q1,
The bank wasn't locked into those expensive obligations.
they just instantly renewed them at the newly lowered 2026 market rates.
Exactly. They essentially weaponized their liability maturity schedule.
Wow.
In a falling rate environment, the ultimate structural advantage is having liabilities that are short-term and assets that are long-term.
So when the Fed made its move in December, Home Bancorp didn't have to wait quarters or years for their expensive funding to wash out.
It rolled off immediately, cascading straight to the bottom line and widening that net interest margin.
This completely reframes the narrative for anyone listening who tracks the Fed.
It really does.
We constantly hear macro headlines proclaiming that if the Fed cuts rates, bank earnings will suffer.
But the impact on any specific institution comes down entirely to the granular reality of their internal plumbing.
And Home Bancorp intentionally engineered their plumbing to capture margin expansion on day one of a rate cut.
It demonstrates an incredibly agile asset liability committee. They transformed a macroeconomic headwind into an immediate catalyst for growth.
It's impressive. But as agile as that internal plumbing is, we cannot evaluate a regional bank today without confronting the massive elephant in the room.
Commercial real estate.
Yes, the dreaded CRE. We are inundated daily with terrifying projections about plummeting property values.
Vacant downtown high-rises.
Right, and regional banks holding all the toxic paper.
Commercial real estate is universally viewed as a monolith of systemic risk right now.
And when investors see that Home Bancorp carries $1.18 billion in CRE loans.
Which is nearly half of their $2.7 billion loan portfolio, by the way.
Right, the initial market reaction is often deep anxiety.
Oh, definitely.
But when you actually disaggregate that $1.18 billion, the macro boogeyman vanishes into these highly specific, hyper-local micro-concentrations,
Let's pull this apart, starting with their owner-occupied CRE portfolio.
which sits at $736 million.
Right. And we are talking about speculative developers leasing out space to random corporate tenants here.
No, this is a business owning the physical structure it operates from.
Exactly. And a massive 24% of that portfolio is dedicated solely to convenience stores.
About $175.6 million worth.
And the geography of those specific loans is the crucial variable.
Let me guess. They aren't in downtown Manhattan.
No. 88% of those convenience store loans are located purely in Houston, Texas.
Which fundamentally changes the risk profile entirely.
How so, for the listener?
If you spent any time in Houston, you know it is a sprawling, aggressively car-dependent metropolis.
Right, without dense, centralized zoning.
Exactly.
Yeah.
In a city built like that, convenience stores and gas stations aren't just retail. They are critical, non-negotiable local infrastructure.
And that is the exact distinction that macroanalysis completely misses.
An owner-occupied convenience store operating on a major Houston arterial road has immense intrinsic cash flow stability.
They sell essential commodities, fuel, food, daily supplies.
They are completely insulated from work-from-home trends.
They are not worried about corporate downsizing or hybrid schedules.
Right. By heavily concentrating in Houston retail, Home Bancorp collateralized cash flows that are inherently resistant to those downtown shocks.
It's like looking at a national weather map.
Yeah, Wall Street is screaming that commercial real estate is caught in a Category 5 hurricane.
But Home Bancorp is standing in a completely dry, sunlit patch of Houston gas stations.
That is a perfect analogy, and the exact same localized logic applies to their non-owner-occupied CRE.
Out of that $625 million bucket, the largest chunk is multifamily housing.
About 29% of it.
And 41% of that geographic exposure is locked in New Orleans.
Which presents a deeply unique real estate matrix.
It really does. You have a densely populated historic city physically squeezed between a river and a lake.
So developable land is virtually non-existent.
Exactly. And strict historical zoning prevents massive new supply from entering the market.
Plus, you have a constant structural influx of hospitality and service workers who desperately require housing.
So a multifamily property in New Orleans enjoys incredibly high barriers to entry for competitors.
Which keeps occupancy rates tight and cash flows highly predictable.
They are playing geographic moats. They avoided generic downtown office towers altogether.
Oh, let's talk about the office space fear, because everyone fears empty office buildings right now.
Right. But their total exposure to non-medical office space is just 6.6% of their entire loan book.
Roughly $181.3 million.
And the performance of that small office slice is arguably the most telling data point of the entire earnings presentation.
Because across both their owner-occupied and non-owner-occupied non-medical office portfolios.
They currently have $0 in non-accrual status.
$0. None of it is failing.
It really exposes how intellectually lazy macro generalizations can be.
If you assume all commercial real estate is toxic, you completely miss a bank generating pristine asset performance.
Because they leaned into the micro-realities of Houston commute patterns and New Orleans housing constraints.
They substituted broad market risk for hyper-local expertise.
And it is paying massive dividends in credit quality.
But, as smart as those micro bets are, no bank is completely impervious to the broader economy softening.
True.
There's some early warning lights flashing on their dashboard that we need to scrutinize.
Let's look under the hood at their actual credit quality metrics.
Okay, let's look at non-performing assets, or NPAs.
These are the loans that are 90 days past due, have stopped generating interest, or where the bank has had to seize collateral.
Right, and these ticked up by 11% this quarter.
Moving from $36.1 million up to $39.9 million.
Which brings non-performing assets to 1.12% of their total assets.
It is a measurable deterioration.
And management attributed this primarily to a handful of specific loan relationships migrating to non-accrual status.
Yeah, including one distinct relationship that accounts for $1.4 million alone.
So in response to that, they doubled down on their defensive posture.
They aggressively bumped their provision for loan losses up to $922,000 for the quarter.
Which is up from just $480,000 the previous quarter.
Bringing their total allowance for loan losses to a very robust $33.7 million.
Which represents 1.23% of their total loans.
Right.
Okay, let me play devil's advocate here, because I want to make sure the scale of these numbers actually aligns.
Go ahead.
In the press release, CEO John Bordelon explicitly stated they, quote, do not anticipate material losses from these new non-performing assets.
He did. He projected total calm.
But their bad loans just jumped by almost $4 million in 3 months.
Yeah.
If I see a $4 million problem appear on my books, and I only set aside $922,000 to deal with it,
Yeah,
isn't that a severe underreaction?
I see where you're going with this.
Is this just a case of executive optimism blinding them to the math?
This raises an important question about the deep mechanics of bank provisioning, and it is a very common misconception.
Okay, straighten me out then.
You have to separate the incremental provision from the total allowance.
Right.
That $922,000 isn't meant to cover the entire $4 million jump in non-performing assets.
It's not.
No, it is merely the new incremental capital they swept into the vault this quarter.
Ah, I see.
The actual defense mechanism, the true shock absorber, is that total $33.7 million allowance they already have built up.
Oh. So the 922,000 is just the quarterly top-off to a tank that is already completely full.
Exactly. And to understand if that tank is truly full enough to withstand a shock, we have to look at their realized, finalized losses.
The actual money that went out the door.
Right. In Q1, their net charge-offs, the money they actually wrote down as unrecoverable and gone forever, was merely $384,000.
Wow. That puts it in an incredible perspective.
Yeah.
They realized less than 400 grand in actual losses, but they were sitting on nearly $34 million in reserves.
When your reserves cover your quarterly burn rate nearly 100 times over, an uptick in non-performing assets isn't a systemic crisis.
It is actually a sign of rigorous internal auditing.
Precisely. By moving that $1.4 million relationship to non-accrual status early, management is recognizing stress before it becomes a structural fracture,
They are actively identifying problem loans
stopping the accrual of phantom interest income.
and dealing with the collateral while they have an overwhelming capital buffer to absorb any potential hit.
They are spotting the rain clouds on the horizon and proactively layering another coat of waterproofing on a roof that is already made of reinforced steel.
It is hyper-conservative credit management in practice.
It reflects a culture that prioritizes long-term stability over short-term optical perfection.
They would rather classify a loan as non-performing today and deal with it.
Then hide it and hope the economy bails them out tomorrow.
Absolutely. So bring all these threads together. What is the ultimate takeaway for you, the listener, trying to navigate and understand this economy?
Well, we constantly hear that falling interest rates will inevitably crush bank margins.
And that commercial real estate is a systemic contagion ready to wipe out regional lenders.
But Home Bancorp systematically dismantles those assumptions.
They prove that national economic narratives are often just too broad.
Right. Macroeconomic weather does not dictate a company's fate if their internal architecture is built correctly.
By aggressively managing their liability durations, they widen their margins in the face of Fed cuts.
And by deeply understanding the intrinsic daily cash flow value of Houston convenience stores and New Orleans multifamily properties.
They have insulated themselves entirely from the collapse of commercial office space.
Success and real financial resilience is never found in broad generalizations.
It is buried in the granular details. It is found in knowing that 96% of a bank's CDs mature exactly when interest rates fall,
allowing them to instantly lower their costs. Critical thinking in finance requires you to ignore the headline anxiety and drill down into the microdata.
And in this instance, the data reveals a bank masterfully navigating economic uncertainty.
By fortifying its liquidity, managing its rate sensitivity with surgical precision, and maintaining a fortress balance sheet.
Which leaves us with a fascinating, lingering question.
What's that?
If a regional bank's survival and profitability rely entirely on understanding the hyper-local microeconomy of Houston gas stations or Lafayette warehouses better than Wall Street does,
Yeah.
are national economic indicators starting to lose their value for everyday investors?
Oh, that is a great question.
Right. If the macro data screams recession, but the local reality is generating record cash flows and expanding margins, does the future of investing belong exclusively to the ultra niche?
It really makes you rethink the headlines.
It does. Something for you to mull over until our next deep dive.